Welcome to this session on market risk management. In financial markets, risk is not an exception, it is the default condition. Every trade, every position, and every balance sheet exposure carries risk, whether it is visible or not. In this module, we will focus specifically on market risk, the risk arising from movements in interest rates, foreign exchange, equity prices, and commodity prices. We will not just define risk in theoretical terms. We will break it down into practical concepts, understand the different types of risk, walk through the risk management process, and finally connect everything to real-world applications used by banks, treasuries, and financial institutions. By the end of the session, you should be able to identify market risk exposures, understand how they are measured and controlled, and appreciate why effective risk management is critical to the survival of any financial institution. In this session, we will proceed in a structured manner. We will begin by understanding what risk actually means in a financial and market context, not a generic definition, but how risk appears in real financial decisions. Next, we will look at the different types of risk faced by financial institutions with specific focus on systematic and unsystematic risk, and why this distinction matters for portfolio construction and risk control. We will then walk through the risk management process step by step, from identifying risk to assessing, treating, monitoring, and communicating it. After that, we will discuss the methods used to treat risk, including avoidance, reduction, transfer, and acceptance. Finally, we will connect theory to practice through practical examples, so you can clearly see how market risk management works in real banking and treasury environments. When we talk about risk in finance, we are essentially talking about uncertainty that can lead to loss. Risk is not only about something going wrong. It is about the fact that outcomes can differ from expectations, especially in an environment where prices, rates, and markets are constantly changing. Every financial decision involves risk, whether it is lending, investing, trading, or even holding cash. The moment you choose one option over another, you are exposed to some form of risk. The key point to understand is this: risk cannot be eliminated. Anyone claiming zero risk either does not understand risk or is hiding it. What institutions actually do is identify, measure, and manage risk so that potential losses remain within acceptable limits. Risk management exists for one simple reason: survival. For banks and financial institutions, unmanaged risk directly threatens profitability. A single large loss can erase months or even years of earnings. Risk management is also essential for regulatory compliance. Regulators do not care about intentions. They care about controls, limits, and evidence that risks are being actively monitored. More importantly, effective risk management helps institutions avoid catastrophic losses, the kind of losses that damage capital, reputation, and in extreme cases, lead to failure. Finally, risk management improves decision-making. When risks are properly identified and measured,